Welcome to the Rose Show podcast.
Welcome to Winning with Macro in a Bear Market with two amazing guests, Chris Perruna and Michael Kramer. Thank you for joining us this evening. We hope to make this space educational and lots of fun. Quick disclaimer, please do not construe this as investment or financial advice. In our space, we will be speaking about preferred times to buy, sell stocks, compare time periods in stocks, some macro, and discuss where the market may be headed. We will begin by introducing our guests, and then we will have discussions with both of them regarding their focus and work. And then we'll take some questions. Due to the overwhelming amount of listeners, for simplicity purposes, we request that you please submit your questions to our thread, which is right on my page at Rosanna Invests. And just submit them in the thread there, and we'll see how many we can get through. Well, I'm Rosanna, your host. I'm an options trader and have been an entrepreneur and investor for over 25 years, focused in equities, real estate, and businesses. I'm currently CFO of an international manufacturing, distribution, and e-commerce business. And I'm also CIO of an investment holding company. But beyond all this, I have an insatiable desire to always be learning and growing. I believe we can always improve and be better in business, in investing, and in life, which is why I'm here on Twitter to share knowledge and experiences with each other. And this is why we're here tonight. Enough about me. Now on to our guests. Not only brilliant investors and traders, but also very kind and generous people. They're so giving of their valuable time to share their knowledge and experiences in order to enlighten and help others here on Twitter. Chris, welcome. Please tell us a little bit about yourself.
Sure. Thank you, Rosanna, for hosting this. Thank you, Michael, for being a part of this tonight as well. Many of you know me from Twitter. I've been on Twitter since about 2009. Prior to Twitter, I actually ran a blog pretty heavily, going back to about 2002, 2003. I guess from a high level standpoint, I don't invest I actually don't invest for a living. I don't invest full time. I don't trade full time. I actually work in real estate. So I started out my career as an architect, and then as an architect, I practiced for about 7 years, focusing primarily on historic preservation. And then from there, I went more into like owner's rep, project management type stuff. I get a lot of questions from a lot of folks. Hey, are you a broker? Are you in the real estate market? What do you think about Redfin? What do you think about this REIT? What do you think about that stock? I mean, everything I do is private, 100% commercial, and outside of any type of public company or the public markets itself. I basically spend my time on Twitter just kind of trading the companies that I like, trading the trends that I like, looking at the different markets that are out there, and kind of just trying to improve myself and just really appreciate my capital over time. I'm not looking to make cash flow out of the market. I'm not like looking to make a living out of the market itself. I'm just looking to kind of put most of my money into passive investments such as index funds, 401ks, company stock. And then I take a small portion of my capital and I try to actually either achieve equality to the market itself or beat the market itself. And I just share that with my folks out in the Twitterverse, and had a really good time, have a ton of followers, love the community, and really appreciate being part of this tonight.
Awesome, Chris. Thank you so much for telling us more about yourself. You're amazing. You have a great following, but you're also a really great guy. And I'm so happy to have met you. And I'm honored that you're on this space tonight. You haven't been on a space in I think it's been about a year.
Yeah. So
I'm so happy you came back 2022 and we're on the space together. Thank you. Michael, we were on a space recently, I think maybe a month ago. That was your first space. Now this is your second. Please tell us a little bit about yourself as well.
Right. So I started my own business, Mott Capital, about 8 years ago. Prior to that, I was a buy-side trader for about 15 years. I've gone to school and spent my whole life basically following and investing in the market. I took a really early interest in it when I was about 16 years old. So that's pushing about 30 years now. And, I really love investing, and I really love everything about it. I've tried to actually step away from the business on several occasions. And I always found myself gravitating back towards it. And what the funny thing is as I've matured and grown older, my investing style has changed. I went from, being young and looking for high flying stocks, like we just kind of went through that period, but instead I was doing it in the late 90s, to sort of trying to trade and move in and out of markets personally, um, looking for stocks, looking for ideas that were just going to be fast gainers. And then as I got older and began to meet more people in the business, I began to realize that, you know, it's a really tough thing to do. And, people who tend to do really well do so with a buy and hold type of strategy and really solid businesses. And so that's what I kind of focus on at this point in my life. I enjoy doing the macro and all the trading stuff because, again, that's what I spent 15 years of my life doing, trading US and international equities. So I take a lot of those skills and I apply them to what I'm doing from a macro standpoint to help me better pinpoint when I want to make long-term and entry points in the market and make long-term exits out of the market, when I should hold more cash in my portfolio, when I should, have be more invested. And that's really how this all kind of came about. And so I love writing about it. I love sharing my ideas with people. And I love just kind of being able to, you know, share all the things I've also gotten wrong.
I love that because we learn from our mistakes. Absolutely. Thank you, Michael. Being an entrepreneur, I've learned to never give up. And I've also learned humility and that failures precede success as long as you never give up. We take our mistakes, we take our losses and our failures, and we learn from that. I always say, I either win or I learn. And that's, I think, a pretty common quote we say in the market. But it's true. You need to take those losses and turn them into learning for the future as to what not to do. But I also learned that timing is very important when you launch a service or product with your business or when you buy investments. Timing is critical as well as your time frame. We know for most investments, you make your money on how and when you buy at time of acquisition. I have also had a background in commercial real estate, Chris. So, and I know you get all that. This is your field. Mm-hmm. It's like when you buy a building in commercial real estate or a stock in the equities market, it's not about timing the market, but it's about buying right. So you utilize some excellent strategies on when to buy stocks via stages, especially important in this bear market. And I admire your patience, everyone. Chris is so patient. It's amazing. Please, Chris, tell us what you look for when you plan to initiate a position with respect to these stages.
Definitely. And Michael brought up a really good point as far as kind of just being in the market, having some experience, taking some time, getting a little bit older, and just having that patience. When I started out, I traded my first stock in 1998. And from 98 till probably about 2003, I was mostly a swing trader, in and out. A few weeks here, a few months, I was in and out of these stocks. And I really didn't hold anything. And then over time, as I went through that dot-com bust and then went through 07, 08, and went into the Lehman Bear Stearns type crisis. And then once I had kids and started a family, I decided just to get a little bit more patient. And what I've also noticed is certain stocks that I traded back in the early 2000s, had I just held them for the last 20 or so odd years, I'd probably be a lot better off than if I just traded those things back and forth. So what I did finally, it actually didn't really happen until 2014. I didn't really establish an IRA that was really built upon stocks that I was just going to put in there and buy and hold. And a lot of those were the FANG stocks and some other stocks such as Johnson & Johnson and Home Depot and Costco, things like that. Your essentials, your big box stores, stuff you go to. But the one portfolio I really talk about on Twitter is the growth portfolio, which goes a little bit opposite of what I do elsewhere within my investing, whether it be real estate or stocks. And what I do there is I'm looking for stuff that's going to be high growth that can give me larger returns versus the market averages in a shorter period of time. So stage analysis is one of the things I learned from Stan Weinstein, Bill O'Neill from How to Make Money in Stocks. CANSLIM is really the foundation of what I'm doing. I'm looking for stocks that are really trending with the trade for the most part. So you want to see a market that's really a healthy market, and that represents the M in CANSLIM. And then you want to see stocks that are in strong industry groups that are kind of trending higher. Maybe it has a new product, a new service, And they're above both the 200-day and the 50-day moving average. So I'd say those are the two key indicators that I look for. I try to keep my indicators very simple and very straightforward for the most part. If a stock is trading above the 200-day moving average and it's also above the 50-day moving average, and that 50-day is above the 200, not to confuse anyone, then that's a stock that's trending higher. And if it's in a strong industry group, that's the type of stuff I want to buy. I've gotten a lot of questions recently as far as, hey, do you only trade on technicals? I don't. I'm a subscriber to MarketSmith. I'm not pushing the product. I don't get paid by them at all. And what I do is I actually screen for stocks fundamentally first. So I'm looking for stocks that are increasing their earnings per share year over year, or stocks that are maybe going to go from a negative earnings per share to a positive, whether it's Q over Q or year over year. And I'm looking for revenue to be increasing year over year as well. So sales, revenue, I want to see cash flow. I want to see net income. I want to see valuation. I look at return on equity, of course, market cap and opportunity. How large is the company now? So if it's a smaller company that has room for a lot of growth, that's the type of stuff that I'm really looking for. And then the last key piece that I really focus on, and some folks like this, some folks don't, is the institutional sponsorship. And what I mean by that is our hedge funds, our mutual funds, our pension funds, our large, smart Wall Street investment money diving into that stock. And you can see that on the charts a little bit with volume. As the stock is going up, you want to see volume on an above average basis when it's on an up day and a little bit lower average on a down day. And then you also want to just look at the number of funds and the number of shares being bought Q over Q. It's a lagging indicator, but usually when a stock's going to go on a run for anywhere from 6 months to 18, 24 months or several years, you're going to see Q over Q increase in institutional sponsorship as that stock's going higher and as earnings are starting to kind of carry that. So what I'm looking for is that stock that's going from a stage 1 base, which is normally a flat base, and then starting to enter what we term a stage 2 base, going into that new uptrend. And there's going to be volatility. There's going to be swings up and down as it goes from that stage 1 to stage 2. But ideally, and what I'm waiting for here in 2022 is I'm waiting for the new leaders to kind of come to the forefront and really appear and start to kind of break out into those stage 2 bases. I don't need to guess a bottom, and that's where the patience comes in. And 15 years ago, I couldn't be this patient. I guess I could dollar cost average and I can start buying into some stocks that I like, but I don't know how much further the stock's going to fall. I don't know if the market's going to make a new low. I don't know if we hit the low already. So I'm just going to wait until some of those stocks and the indexes themselves kind of recapture that 200-day moving average and start to move up, because if it's going to be a sustainable run after they get above those 200-day moving averages, then I'm going to have plenty of time to kind of jump on that trend. I'm never going to get the bottom, probably not going to get out the top, but you're going to get a solid 60, 80% of that run. And that should be more than enough to give you some great returns over the next, say, 1, 2, 3, or 4 plus years.
Absolutely. Very nice. Now, when you talk about the stage 1 to stage 2 area, are there any stocks that you see are in that particular area that are on your watch list right now?
There's very few right now. I mean, if you look at even like today, if you look at, there was 13 new highs today, like Enphase, which is really hot stock. I know you own the stock for solar. There's a couple other utility stocks that are on the new high list. I'm only seeing 13 stocks in new high list. When you're in a pure bull market and you're looking for a lot of strength in the market, you want to see dozens and dozens of stocks on the new high list. There's not a lot right now, which also means there's not a lot of stocks that are really breaking out of that stage 2 base going into a new uptrend. So I'd say there's very few stocks right now that I'm looking at. There's been a couple I've profiled on Twitter over the last couple of weeks. But I'm very cautious just because the NASDAQ, the S&P, and the Dow, they're all below the 200-day moving average. And right now, I think the NASDAQ's about 27% below its high. S&P is a little bit less than 20%. And then your growth stocks, I mean, so many of them are still anywhere from 40, 50, 60 to 70 or 80% below their all-time highs and well below the 200-day moving averages. So right now, it's the industries that are making new highs. Yes, I'm not really a trader, so I'm not going to go after the energy stocks. I think they're very cyclical. You can make money in them. A lot of people do. It's not really for me. I'm looking for your growth industries. I'm looking for your technology-based, your computer-based, maybe some of your biotech-based companies. When those industries start to show some strength and you're seeing a number of different stocks coming out of those stage 1s into stage 2s, that's when I'm really going to start to jump in. That's when I'm going to start to buy new stocks. I'm not going to buy everything all at once. I usually kind of phase in or pyramid up in the stock. So I'll buy a quarter or a third of maybe a full position. And if the stock acts well and doesn't reverse, then I'll start to add in a little more after that.
Love it. You read my mind. I was going to ask, how do you scale in? So do you scale in? If it goes down, do you add more? Or are you more of you cut your losses quick? Do you have a stop loss that you work with? Or do you prefer to add on its way up?
I do both. I mean, sometimes when they really take off, you don't have a chance to really get it when it pulls back. So you want to grab it when it's just going up, and sometimes you'll pay a little bit more than you want to. Once it gets above the 200-day moving average, a lot of times when a stock recovers that, if it was below it, or maybe it's a newer IPO and the 200 days just being established, the stock will break above it, and oftentimes it will have that first pullback to the 200-day. And as long as it holds that as support, in my mind, that's an area where you want to add some shares if you already bought. If you haven't bought, that should be a nice ideal first time to buy the stock. Now, if it doesn't come back to 200-day, that's where I start to employ the 50-day moving average, usually on uptrends. I don't really do it on downtrends, but on uptrends, when stock is above the 200-day and you can't really get it back there, but you really want to get in, look for times when it comes to the 50-day, and that's where you can add. And that's normally what I'll add in the stock at that point. I'll kind of just pyramid up. And there's nothing wrong with pyramiding up in the stock, whether you buy it higher on a pullback. You want it to be higher than your initial buy. So you actually want to average your cost up in a stock that's growing and a stock that's going to give you some great returns over time. You don't want to average down. If you're talking about your Microsofts and your Googles and your Apples and they're giving you a 20-30% discount right now in the market, those are the types of stocks you can probably average down in right now. I own them in my IRA. I'll add more to them over time. But that's not the kind of stock that I'm looking for when it comes to just pure growth if it's a new name. I want a stock that's blasting to new highs, above that 200-day moving average. And oftentimes you want a stock that you almost can't get a second or third time because it just keeps running. Those are the ones that are really powerful. Those are the ones that can give you a 2x, 3x return in as quick as 6 to 12 months.
Love it. Now, I'm going to have to ask you, are there any particular stocks that you have your eyes on because of their business model, their growth rate, and so forth, that you are watching closely for that move on from stage 1 to stage 2? Could you share with us any of those particular ones that you like the business model of?
So when I go back to my experience and I go back to 2002 to 2004, and then I go to 2009 to 2010, a lot of the stocks that led the markets in those previous bull runs, whether back then it used to be your Amazons, your Netflix were in the early 2000s. There's a different crop of stocks in 09, 2010. I do think some of the beaten down technology stocks, your big companies, your big brands, I'm very big on brand stocks, companies that have brand recognition. So if you talk to your family, you talk to your significant other, your children, whoever it may be, your friends, and even though if they don't invest in the stock market, but they know the brand itself, those are the type of companies that I do think will come back. They may not be the ultimate leaders, but I still think they can go on runs for a 2x, a 4x, a 5x, or 10x. So I look at a lot of those stocks that were beaten down in 2021 and now in 2022 that may be starting to form that first base, that first phase 1. But I'm not going to touch them until they go into that stage 2. Until they get into that stage 2, I'm not going to go after it. I know you're looking for individual names itself. I don't have any individual names right now. Like I said, I profiled 3 or 4 stocks in the last couple of weeks. I'm just watching them right now. I don't know where they're going to go. And the other thing, another caveat I'll throw out there, just historically, September's a rough month. So I'm very cautious during September just because it is the poorest performing month over the course of the last 100 years or so. Doesn't mean we're going to have a bad month this month because there is about 35% of the time it is an up month, but I'm just very cautious right now. I want to see the market in general because the Nasdaq's below the 200-day moving average. I'm really just not buying anything. I don't really have a watch list because I'm suspect. Everything is suspect until proven otherwise, in my opinion, based on the way I invest right now.
Agree. Makes sense. I love it. I love the patience. That is admirable. And so you said growth sectors. Any particular type of growth sector? Do you like more of the cloud computing, the biotech? Any particular sectors that you are more focused on in that arena?
Yeah, I think when it comes to technology, one of the things I really focus on is any company that has recurring revenue. So subscription model, subscription-based services. Being an architect myself, one of the biggest misses I've made in my entire life was Autodesk, AutoCAD, the makers of AutoCAD. And when they went from a one-off, just selling a CD every year or two, you had to upload the latest AutoCAD, and they went to more of a subscription model, their stock just went off and took off like crazy. And that's a company that's been around for a really long time. And I think the stock went 8 or 10-fold from that time when they actually made that decision to go to that recurring revenue model. So any of the tech stocks, whether it's software as a service, whether it's semiconductors, whatever the company may be, if they have some type of a built-in recurring revenue model, and they have earnings that are growing Q over Q and year over year, that grabs my attention the most. So those are the types of stocks that I'll go after. And if it's any type of technological type industry, then I'm 100% for it. And that's the type of stock that really gets me excited.
Perfect. Thank you so much. Now, conversely, is there a certain time that you prefer to sell? I see you just, I saw some of your tweets. You said stage 3 to stage 4, and then you tweeted that there were a few stocks that may be headed into stage 4, such as the big guys, the Microsoft and Google. Does it still look that way? And is that when you would technically prefer to sell?
Yes. So in my IRA, stocks like that, I'm not going to really sell. It's very rare that I'll sell something like that. AT&T is a stock that I sold out of my IRA this year, and that was something I've been talking about for a year. I just didn't really like the way it was acting. I didn't like the way it was splitting up. It had a dividend. I kept it there for a number of years. But your Microsofts, your Amazons, your Facebooks, your Apples, I mean, these are your biggest companies in the world. These are your biggest brands in the world. They're going to be here in 5 years and 10 years. They're probably going to double or triple from the points they're at right now. I mean, they've done it over and over for the last 10, 15, 20 years. I don't see why they're not going to do it going forward. So those are the type of stocks that I keep. Those are stocks when they get discounted 30 or 40% and it looks like they hit a bottom that I'll add more shares to. When it comes to selling any of the growth stocks that are not your biggest brand names, you want to sell them once they break below the 200-day moving average. I usually wait. I usually give it time because there's a lot of times a stock can break below the 200-day and then recover it fairly quickly. Once it breaks below a 200-day moving average, after it's had a long run and now it's starting to struggle, you're looking at volume. Maybe it's heavier volume on days it's down. If the stock can't come back up and recover that 200-day within several weeks to a month or so, and then it actually bounces back down on the underside of the 200-day, that's a clear sign that it's at stage 3 looking to go to a stage 4, and you probably want to take some off. So the same way I pyramid into stocks is also the same way I usually pyramid out of stocks. I don't sell everything all at once. I usually don't. And again, it's not a hard rule for every single position that I hold. A lot of times I'll say, okay, if I have a full position in a stock, let me just sell a third here, see how it reacts. And then if it goes down a little bit further, I'll sell either another third or another half, or just sell the whole thing at that point. Now, nobody's perfect. We make mistakes. Michael made a good point earlier. We learn from our mistakes. I sold a lot of stocks last October, November. I probably should have sold everything in my growth portfolio 100%. I didn't. I held on to a couple legacy stocks because I just like the companies. I like the brands, and it's cost me some money. I mean, this year, that portfolio is down about 18% at this point, and that's with holding 90% cash now. Now, it wasn't always 90%, but coming into the year, it was between 40 and 60%, and then I quickly got it up to 70 to 80%. And for the last 5 months or so, I think it's been sitting close to 85 to 90%. And as of today, it's over 90%. And I have a few holdings in that portfolio right now, and it's just legacy shares that are left over. And I've sold shares in every one of those companies since I've owned them. And it's just 1% positions that I'm like, you know what, I just want to hold it because I just want to own a piece of this company at this point in time. But once they start breaking down, and once they can't recover that 200-day, and then when the 200-day line starts declining and it looks like it's heading downhill, that's when you want to just totally abandon the stock and just get out of it at that point, especially if you're in a shorter-term growth portfolio. If you're truly a buy and hold investor and you just want to add over time, it could be dangerous. And there's some folks that I know that have held stocks over the last year and they're down 70, 80, 90%. I've spoken to folks that have portfolios down 50 and 60%. It happens. It's not ideal. And it's going to take a lot just to break even at this point. It could take a year or two before they break even. I mean, if you think about a stock that's down 70 or 80%, it has to go up 4 or 5x just to break even to its previous high. That's a lot of ground to make up just to break even from where you were at some point. So I prefer to get out of those stocks, and then I can always get back in when they start coming up. Again, I'm not looking to try to get the bottom. I'm just trying to get the next trend up rather than trying to guess where the bottom may be.
Exactly. Love it. You scale in and you scale out. I do similar type of trading. And I love your tweet that says, I do not buy breakouts during a bear market. That was a great tweet. I just retweeted it now. It's stock and index below a declining 200-day moving average. That's simple and sweet. Okay, so I have some questions for you regarding the bear market overall. There's a bear market in stocks. There's a bear market in bonds, the first in 30 years, and now potentially real estate. Rising rates tends to soften real estate. Mortgage demand, I think, falls to lowest level in 22 years, I believe. Inventory starting to rise. Prices are starting to come down regionally. What are your thoughts? Do you think that's our next challenge?
I do. I think but it's much different than 2008, in my opinion. I think we don't have the same situation where folks were buying houses, no money down. I think home prices just got ahead of themselves. And now with the interest rates going up, the cost of a mortgage is a lot higher. So I think that's what people are scaling back on. So we're not seeing as many homes being sold at this point. We're not seeing the bidding wars. Now, there are pockets of the country where you're still seeing that. I actually have a neighbor right down the street from me. She just sold her house, and it sold in 3 days, and she had 5 offers within the first day over the asking price. So if you're living here in central New Jersey, you're living in the New York tri-state region, I know there's pockets elsewhere around the country where the market's still booming, but overall it's slowing down, and there are areas that's slowing down, and real estate is a lot slower than the stock market. So you'll see other areas kind of give you that red flag. They'll start to slow down first. And just like certain growth stocks that are down 90%, and other stocks like Tesla may only be down 15%, some markets are only going to go down a little bit while others are going to get crushed here. And it's based on the support. I think the pandemic really changed the dynamic where people went, where they bought houses, whether they're buying second homes, they're buying Airbnbs, rental properties, whatever it may be. With interest rates going up, and they're going to continue to go up a little bit more here, so the Fed can fight inflation. Inflation is coming down a little bit at this point, or at least it's leveled off. But one thing that some people like him, some people don't, Michael Burry put out there, if you look at a historical inflation chart, it comes in spikes, multiple spikes at one time. So we're really just in that first spike now. This might actually level off and go down, but we may see another spike in a year or so when inflation goes right back up, if we're in a longer term inflationary type environment, which I think with all the money printing out there, I think that's what we're in. And I don't like what the Fed's doing with all the printing that they're doing. And it's not just our central bank, it's all the central banks around the world. And you're seeing banks now in Europe, what they're probably gonna have to do is bail out all these energy companies, just like we bailed out our banks. I'm not a big fan of bailing out companies. I'd rather see them fail. I know it's controversial, but I'd rather see them fail and see people actually have repercussions of making bad mistakes. And I think folks need to have that so they know, hey, if I run a bank or I run an energy company and I do something that doesn't go well, I can lose my job, I can ruin the company, and if I'm doing something illegal, I should go to jail. And I think unfortunately we allow certain folks to get away with certain things, and then the taxpayer always bails them out. So whether you're in the US or in Europe, the taxpayer is always going to bail out these companies. So I do think that sometimes the government can kind of soften the blow here, but the longer we kick this can, I think the harder it's going to be to kind of avoid a major crash at some point. I don't know if that's now this year, but it's certainly at some point in the future we'll have it.
I love your straightforwardness, Chris. This is something I learned about you a long time ago when I first started following you. You are so transparent and you're so straightforward, and I appreciate it. And I think everyone appreciates that. So that leads me to the next question I have for you, which is how much I admire how you attempt to decipher the truth from the headlines. And there are a lot of headlines out there, but not necessarily all true. So we have high inflation, and I appreciate you mentioning that and how it comes in spikes. I agree. And now we're either in or headed into a recession with a changing definition. What are your thoughts on that? And are you confident with the Fed's plan? Now, you sort of implied that you aren't, but could you just go into greater detail about in your opinion, about the Fed's plan and what they can do to stop this inflation that we have?
Yeah, so the Fed, I think, in my opinion, is they just acted too late. They should have acted a lot sooner and should have started raising these rates a lot sooner. And I think it could have headed this off a little bit better than what they've done so far. I'm not going to get into all the politics of what happened during the pandemic and what was printed, what wasn't, but we are where we are. We printed. They're going to go through a period of QT now versus QE. And inflation is going to come down because they are raising those rates. But now the next question becomes, if you look historically, once inflation starts to come down, normally that's when you have a very low period of unemployment, which we've been at historically low, 3.5% or so. Every other time throughout history when we've gone below 4%, typically within 6 to 12 months, there's a recession that follows. So I say historically, looking at treasury yields, the bond market, the stock market, inflation, geopolitical things that are going on around the globe right now, it's certainly not out of the question that A, we're already in a recession, or we're definitely B, heading into a recession. How severe that recession is going to be, I have no idea. That's anybody's guess. I think one thing as an investor or a trader or anyone that's involved in the market, you have to be able to change your opinion on a dime when new information becomes available. So in my mind, I may think we're going into a recession. The one thing I'm looking at is the NASDAQ and the S&P. If they're trading below 200-day moving average, it's a downtrending market. NASDAQ's 27% below its all-time high. I mean, it is a bear market for the NASDAQ. Until that changes its position, I'm not going to change my position or my patience as far as just jumping into stocks because we have a bear market rally. And we saw one back in March. We saw one just now last month. We'll probably see a couple others. We go back to 2001, 2002. You go back to 2008. There's 4, 5, 6, 7 different bear market rallies where the actual index itself was up 20, 30, 40%. Certain stocks were up over 100% very quickly within a matter of weeks. But then before you looked at it, when you looked at the overall move of the market, it was down 78% from that high in 2000 to the low in late 2002 or early 2003. So could we make lower lows here? I think we could. I'm not saying we will. And if the market were to turn back up tomorrow and we have a great month in September and October does the same, we're above 200-day moving average, I'll start buying. But I am concerned about the macro environment. There's just so much stuff going on here in the US, obviously in Europe, Russia, out in China and Southeast Asia. There's just a lot of stuff out there where you can potentially get one of these black swans that just tanks the market. One thing I talk about a lot on Twitter is the ultimate flush. Usually you get to a bottom of the market when you see an ultimate flush. And what I mean by that is you'll have a period of 2 to 3 weeks where you have high volatility where the market be up 4 or 5% one day, down 4 or 5% the next. And it will do that probably a half a dozen to a dozen times over several different weeks. We haven't had that yet at all. I don't believe we had it. If I look at my data, we haven't had that yet in 2022. So I believe until we get that, and it doesn't mean we have to have it, but I believe until we get it, we probably haven't seen the low in the market yet. I hope I'm wrong. Obviously, I'm invested. Everyone on this call is invested. I don't want the market to go lower. I want the market to go higher. I mean, 2020 was fun. 2020 was one of the best years I ever had, and it's one of the best years anyone's ever had. That's the type of environment we want to be in. It was a little extreme, but you want to be in a market that's going up, not a market that's going down. So as much patience as I have just sitting here holding and not making any moves right now within the growth portfolio, I'm waiting for those signals to come in so I can start buying some stocks again, because it's been quite a while. I mean, we're already in September. I haven't bought a stock in that portfolio since February, and it's been quite a while, and I'd like to get going again.
Very nice. Thank you so much, Chris. If anyone has questions for Chris, please submit them in the thread, and we'll try to get to as many of them as we can. Appreciate your perspective, your macro outlook, everything. Thank you. And the key thing is that you're remaining flexible, and you need to be flexible. You follow price, and anything can change. And the market does what the market wants to do ultimately. So we just got to remain vigilant and patient, and we will all be great. So next we will speak with Michael. To me, Michael is just wonderful with his comparisons with charts. He compares stocks, time periods with indexes and volatility, equity risk premiums, real yields, and more. Now, in life, we learn through comparison. So we compare rather than study things in isolation. It is through comparing similarities and differences that we learn about situations, time periods, and objects. Things are darker, lighter, shorter, taller. So for example, when you place the color teal next to green, it can look more blue because you see what it is not, and vice versa when placing it next to blue. Similar with time periods, no two time periods are exactly alike. Of course not, as there are so many different variables. However, there are similarities along with the differences, so we can understand and learn and hopefully make better decisions this time around. In the famous words of Winston Churchill, those that failed to learn from history are doomed to repeat it, which is why I believe Powell is referencing the runaway inflation of the 70s and 80s and its consequences, and now wanting to avoid that prolonged inflationary period by being more restrictive and continuing their plan until it's complete. So when people think of current inflationary environment, they are quick to think of the 70s. But I have to say, I've been looking at the 40s as well due to the conditions that we're setting up for it. And if you actually look at the primary cause of the inflation and the response to that, our current situation does resemble the 40s. It's just fascinating and interesting to look at. And as the old saying goes, history doesn't repeat, but it does rhyme. So without further ado, I want to welcome Michael. And we want to speak about your comparisons between rising rates, QT, inflationary pressures. We're in a tightening financial environment, exactly as you say in your most recent Seeking Alpha article. And I quote you, because at the end of the day, higher rates, a strong dollar, and tighter financial conditions will continue to be bad news for stocks, as they have been for all of 2022. So tell us, Michael, is this like 2008? I see your chart. You seem to compare 2022 to 2008. Could you please tell us what similarities you see?
So it's similar and it's different. And it's interesting because I just recently did a story on Seeking Alpha about a week ago, saying that if history repeat itself, we might have further decline. And you know, obviously the financial crisis in 2008, having been working on a trading desk at that time and living through it, was a very scary experience, um, especially when you were dealing with the people who were working at the firms that the issues were occurring at. And I think the similarities between this period and 2008 is that in 2006, 2007, I don't know if many people remember, oil prices were very high, copper prices were very high, inflation was very high, gasoline prices were very high. I mean, and that those inflationary pressures, obviously led the Fed to tighten rates, which led to, higher interest rates, tighter financial conditions, which began to, really corrode and eat away at the financial system. From the standpoint of we're in a tightening cycle, we're seeing financial conditions tighten. You have high inflation, although it's much higher today. That's where the similarities are. But we don't have the same rest of it, which is the post Lehman period, which I hope we don't have, because that living through that once was enough. Um, and and so I think where the similarities lay between 2008, 2000, and even 1937 aren't so much to do with the macro backdrop or the news that's kind of driving it, but it's the reaction and the expectations of how the Fed is going to handle certain things. And for example, I wrote in, like I said, on August 28th, a story, and I took believe it or not, you can go back and find stories from the year, December 21st, 2000 from CNN Money, which is long changed and transformed. And you can find these old stories. And, the reason why I picked December 21st in the year 2000 was because in the year that was the most equivalent time period and time frame in terms of where we are in the cycle to where we are today. In fact, if you sort of go back to the year December of 2001, I'm sorry, what was it? December of 2000, you would see that we had a pretty big rally during that period of time, where we went up from around 1260 on the S&P up to almost 1400. And what was interesting was that what sparked that rally over that period, over that time frame from December to February, was basically there was on that day, the latest economic figures from the government showed further signs of a slowdown, giving the Federal Reserve more ammunition to cut interest rates next year, referring to 2021. And then when you fast forward to March of 2021, when the market February 2021, where the market started to turn lower again. I'm not 2021, February of 2001, what sort of turned the markets lower. Basically, the market was disappointed because, according to the article from February 2nd, 2001, in fact, there's a chance that the March rate cut might be a quarter percentage point and not the half a percentage point the market expects, right? And so sounds vaguely familiar to what we're going through today. It's these expectations of how the market kind of ebbs and flows, earnings, Fed, interest rates. And that's where I think the similarities today are very similar to what took place in those previous cycles.
Very nice. So you would say it has quite a bit to do with the human reaction, the human emotion element as well?
Right. It's because, I mean, look at what just happened in July. All Powell had to do was come out and say we were at neutral, and we may at some point slow the pace of rate hikes, and the market goes berserk, right? Because the market has that reflex muscle memory of what the last 10 or 15 years has been, is that the Fed comes in and cuts rates at the first sign of weakness. And that was basically the same reaction in the year 2000 and 2001. It was the same reaction really that occurred if you go back to even 2008. In fact, um, you know, if you go back here to March 18, 2008, stocks jumped the fourth biggest day point gain ever after the Federal Reserve cut the federal funds rate by 3/4 of a percentage point, surprising investors looking for a larger cut. And and then of course you fast forward a couple weeks later, what's kind of also, and again during this period of time there was a very big rally in 2008, and what was kind of helping to prolong that rally was better than feared earnings, right? Sounds familiar to what we're going through right now. That was the narrative that we just went through, right? The market rose on expectations that the Fed was going to maybe pivot, and it was bolstered by better than feared earnings, right? Same narrative, same story. Now, what's causing the market to go back down again? Well, because the market's realizing there isn't going to be a dovish pivot, right? And then what happens in 2008? You fast forward to May 21st, 2008, the market begins to go back down again because it became apparent after reading through the Fed minutes, the Fed wasn't going to ease as much as they expected. So history repeats in many, many forms, and it sounds vaguely familiar to what we're going through right now. And so that would suggest to me that what we're going through right now is very familiar and very much like what we've been through in the past. And if those past experiences are a guide to the future, it tells me that the Fed is going to continue to be aggressive, right? Because we know inflation is very high. And right now, that's the Fed's main concern. And growth is not their concern. And that means that markets are probably going to continue to go down until the Fed changes its policy path. And that's not likely to happen anytime soon.
Got it. I agree with you. They're very hawkish. Their focus is to bring down inflation at all costs at this point. So agree. And I love the I don't like the comparison. I don't want to think that we could follow that pattern. However, I find it brilliant that you were able to put those two together as you have in your chart. And then, another comparison that you make that I find really interesting is NVIDIA and Cisco. To me, they're vastly different. I know they're in similar sectors, but they are different business models. But so far the charts look very similar. How did you make that comparison, and why are you making that comparison between NVIDIA and Cisco?
So the reason why I started to do that was because I had already at that point, well, I first kind of came upon it around Thanksgiving weekend in 2021. The reason why I found it was because I already had established that by that point that the S&P 500 was very much mimicking and following the path from this fall of 1998 through the 2000 cycle. And one day I was looking at a chart of NVIDIA and I went, "Oh my God, this looks really familiar to me. I've seen this pattern before." And basically, it was just sort of that straight line up phase it was still in. And I said, "Wouldn't it be interesting to see if I overlaid this with Cisco?" And I knew Cisco extremely well because, of course, I had bought it in 1999, and I rode it all the way up to $80 or so. And then, of course, as it was going down, I had sold some of it, but then I kept trying to buy it back, thinking it was cheap. That was the mistake of my life. And uh, I threw the chart together. I saw that they had a similarity in terms of the way their base is kind of built, the way that the exponential move higher was kind of configured. And I threw it out on Twitter, and I got a really strange response. I wasn't really expecting so many people to respond to it, to be honest. And I've just been following it since. Um, and I haven't changed anything on it. I just let it run every day, whenever I go in and check and see. I used it basically pretty well to figure out some of the major turning points in NVIDIA over the last year, going back to December, going back to April of this year, even more recently. And what's interesting is that even their revenue growth and their price to sales multiples are similar, because what I've kind of learned over the last 30 years or so is that the market has these darlings, and I think Chris kind of talked to this a little bit before. The leadership. You had, General Electric at one point. People who may not know this today, was the largest company in the world back in the late 90s, right? Apple was not Apple, right? Because Apple was on the verge of going out of business, and it wasn't until Microsoft basically saved them and allowed Windows on the Mac, and allowed some of the office type products eventually there. And it wasn't until Steve Jobs came back in 2007 or he came back sooner with the iPod, but it wasn't really until the iPhone came out that Apple became Apple. And Amazon was just, Jeff Bezos was, just starting the company. But what I kind of realized was that there are certain darlings of the market, and those are the ones that the Qualcomms, the Ciscos, the Intels, these were the companies that were really sort of the innovators at the time. Cisco was basically, the story basically was around Cisco, was that they were the backbone of the internet that was being built out across the country, right? And everything needed to go through them. Not really all that dissimilar from the story today, which is the cloud. Well, NVIDIA is supplying the graphic cards, the GPU units, to the cloud to help build that out, right? And so even though they're different sort of concepts, the investor base is sort of similar in the emotional attachment to it, not believing that the narrative can turn. It's the same mentality, the same emotional attachment to it, falling in love with a stock, right? And that's usually where things can go wrong.
I love it. I think it's a great argument you make, and you're convincing me. So I think it's great. It's the human emotion element. It's that feeling, the darlings of the market. I understand what you're saying. It's still hard to believe, but you make a lot of sense. So thank you so much for explaining that. I loved your tweet that I think it was yesterday or today. I don't know when you did it. Sometime this week. You say history is in the making with the dollar, rates, and stocks. Could you please explain what you meant by that and your thoughts on the dollar and how it's hovering and holding around 109, 110?
Well, first of all, if you're international and you live outside of the U.S., you know the effects of what the dollar are doing to you right now. Especially if you're in a country where you're importing a lot of goods that are priced in dollars. It's becoming very expensive. So basically, what the U.S. right now is doing is exporting our inflation. And we're exporting it to everywhere in the world. And by the dollar strengthening, we're really bringing in sort of deflationary forces. The stronger the dollar gets, the cheaper goods will be to import. And that really has a major consequence for the rest of the world, because everything is becoming much, much more expensive. And if you look at a chart of the EEM, it's sort of like explanatory there. You're trading well into the range of the pandemic back to June of 2020 levels. And so this is really an identification of the effects and the ramifications of what the strong dollar are having around the world. And then when you look at the carnage in terms of what's happening to the dollar with the yen, when you look at it versus the euro, when you look at it versus the Chinese yuan, these are historic moves where the yen hasn't seen these levels for more than 20 years, and the euro 20 years ago. That the dollar is this strong, right? Going into the pandemic, everyone's like, "Oh, the dollar is going to, be worthless." It's all relative, right? Because if everyone else is going down too, you're going to want to own the reserve currency, which is still the dollar and will be the dollar for a very long time. And so, while everyone is focusing on the S&P 500, you need to really be focusing on the dollar, because that's having very broad and impactful and damaging ramifications for the global economy. And you need to be focused on rates because rising rates obviously increase the cost of doing business. And the two things together create tighter financial conditions, which we know are bad for stocks. So the higher both of these things go, the more damage they're creating to the global economy, the tighter they're making financial conditions, and the less likely it is that stocks can have a sustainable long-term rally at this point. And that's why I say it's history, because the dollar is doing things that hasn't done in 20 plus years. And rates are going back to levels not seen since before the great financial crisis, the 2-year, the 5-year, the 10-year, 30-year. They're all going back to these levels not seen in nearly 2 decades.
Agreed. I agree completely. Thank you for explaining it so eloquently. You know, Chris tweeted about how the bond market has no fake outs like stocks. I like that tweet. It was also it's very true. So you please tell us, Michael, what is the bond market telling us? And also, if you can also add in there, the yield curve between the 10-year and the 2-year is now starting to flatten. A few weeks ago, everyone was in an uproar. Oh, we're hitting negative 0.5%. Now we're less than negative 0.2%. And it's not as inverted. It's becoming less inverted. So what do you make of all that?
So, I mean, to Chris's point, the two most important markets that need to be followed, especially when it comes to Fed rate policy, are the bond market and the currency market. The bond market to kind of get a sense of what the market is thinking about, and the currency market to validate that point, right? Because in theory, they should both be telling you the same thing. Stronger dollar means probably higher Fed funds rates, higher interest rates, rising rates indicative of a Fed that's going to be tightening policy, right? And so while the equity market was on its dovish pivot kick, the bond market and the dollar were clearly telling us that there was no dovish pivot, there never was a dovish pivot, and there wasn't going to be a dovish pivot, right? And if you weren't looking at them, you totally missed what was really happening. And so that's I agree 100% on that topic. In terms of why the yield curve is inverted, what happened there, I think the market's knee-jerk reaction was we got 2 quarters of negative GDP growth. We must be in a recession. And the truth of the matter is, I kind of disagree here, but with Chris, where he mentioned he thought we were in one, I don't think we're in a recession. And I think what's happening is that the bond market was actually faked out for a little bit, thinking we were in a recession. And now what you're seeing is the back end of the curve start to re-steepen again. And that's allowing the 10-2 spread, or the 2s and 10s, whatever you want to call it, beginning to see that curve, that rate come up, that spread come up. Because what the market realizes now is that essentially we're not in a recession. The 2 negative quarters of GDP growth were really caused by a number of factors, such as inventories falling and high import-export prices. Because when you looked at gross domestic income, that was actually positive last quarter and the last 2 quarters. And when you average GDP with GDI, they've been positive since. They've never gone negative, which would suggest that there is no recession. Plus, when you factor in ISM services, it's kind of indicating a 2.5% annualized 3rd quarter growth rate. So I think the bond market is starting to realize that it made a mistake. Maybe there is no recession currently, or maybe the recession is, remember, the inversion really means that there's going to be a recession within the next 12 to 18 months. So it could be that the bond market's sort of repricing because it thinks it made a mistake, or the bond market's starting to say in 18 months from now, the Fed's going to be probably starting to either ease or not be raising rates anymore. The other alternative is that the bond market may actually be telling us that inflation is still going to be an issue. Because if you look at 3-year break-even rates, they're actually higher than every other point on the break-even inflation curve. So it could mean a couple of different things, but that's what my takeaway is.
That's great. Thank you so much. I do seem to see that cost push inflation is embedded still. I just received a letter this past week from one of my vendors that they're raising my cost of goods sold, and they cited soaring fuel costs, ongoing labor challenges, and constant supply chain issues. And they want to raise the price of these items by approximately 5 to 10%. So I'm still seeing prices going up. And so to me, I'm not convinced that inflation is coming down that quickly or that much, or even that it has peaked. I have yet to believe that. I know it's a lagging indicator. It's also looking backwards. It's not a forward indicator. We know that. But when I see letters like that to my business that prices are going up, it is concerning. And so we do see it across the board. Margins are being compressed. I'm not going to go into that whole thing, but I always talk about that. But to me, I'm not fully convinced. So we'll have to watch and see. You wrote a great article on Seeking Alpha again. That's how I found you, Michael. You're on Seeking Alpha. I'm a premium member on Seeking Alpha. I love Seeking Alpha for their articles, and I found you there, I think, over a year ago. But you wrote an article about the equity risk premium and the spread between the S&P 500 and the 10-year yields. And you really made a great point there. And I think it's important that you discuss that little paragraph that I had shown you I was very interested in. If you could discuss that to everyone and just speak about that spread and what it means for the S&P, how valuations need to come down, and where you think that spread needs to be about, and what PE and price we should be at for S&P 500, please.
So if you want to think about it really in simplistic sense, right? The S&P 500 is what's an earnings yield, which is basically just the inverse of the PE ratio. So instead of doing the price divided by the earnings estimates, you do the earnings estimates divided by price. And that gives you sort of an earnings yield of the S&P 500, which is currently around 5.7%, I estimate, using 2022 estimates. And if you take the 10-year rate and you subtract the earnings yield from the 10-year rate, you get about 2.4%, which is basically the premium that you're paying to own stocks over the risk-free rate. And that's historically a number right now that's extremely low. The lower that value is, the more expensive stocks are relative to bonds. And if we look at that value today, going back over the last 10 years, the only time it was more stocks were more expensive than they are right now was back on, it was just April 18th of 2022. So just this year. So basically what that tells us that stocks right now in this time frame, because rates are rising so quickly, are more expensive today than they have been at any point in the last decade. And that's really impressive because we just came from a period in time where PE multiples were higher than they had been in the past 20 years. And if we think about it, if interest rates are rising, probably should mean that the earnings yield, or the interest rate on the earnings, the rate of return you earn on your S&P 500 earnings should also be rising. And so if we kind of look back on a historical basis, at least going back to 2010, I mean, you can go back further, 2009, the average PE ratio, the average earnings yield spread or equity risk premium is 3.75%. We currently are at 2.4%. So we're nearly 130 basis points below the average. So the average, over that time period, the range has been between 2.2%, call it, and a high of 7.4% in the kind of the depths of October 2011 when we were going through the sovereign debt crisis in Europe. So if we kind of look at one standard deviation from the mean, you're talking about 2.75. So assuming that the 10-year rate, let's say, stays where it is, and we tack on 30 to 35 basis points on the current earnings yield of the S&P 500 of about 5.7, you're talking about an earnings yield on the S&P 500 going to around 6, which is somewhere around a PE ratio of 16. So, versus where it is right now, I think that, let me just figure it out really quickly, maybe 17 and a half. So, that's a pretty decent decline from where we are right now. And, honestly, I think ultimately, as kind of Chris pointed out too, is you kind of get that capitulation moment, that washout in the market. Typically, when we do finally wash out in the market, typically that's come around a 13 to 14 PE. And that's how I arrive with my 3,200 value on the S&P sort of longer term.
Very nice. Thank you. So that leads me to the next question, which I think you just pretty much answered. I was going to ask you if you believe we're going to retrace to June lows only, or do you have belief that we may go to new lows? And it seems with that number you just said that you anticipate we may go to new lows this year. Is that correct?
Yeah, I don't know if it's going to be this year that I think we're going to see a number sub 3,600 probably this year. Whether or not we bottom this year or not, it doesn't really matter to me. It could be within the next 6 to 9 months that this could be playing out for. It really depends on how long the Fed wants to drag its feet. But yeah, I think right now we've already started that move lower. That's going to take us to our new low. Because look at where TIP is. Look at where the TIP ETF is. That's made a new low. Look at where rates are. The 2-year yield just made a new high. The 10-year real yield just made a new high. The 5-year real yield just made a new high. The dollar index is making a new high. Go through the list, and the TLT is basically at a new low. So the only market that's not even really close to the TLT making a new low. So the only market that's not really kind of going along with this little making a new high type of party is the equity market, which should be making a new low. And that's why the valuations are so expensive right now, because rates are rising so quickly. The equity market's actually not falling fast enough to keep pace with the rise in rates. And that's really the part that's sort of scary, because, when you look at that comparison between 2008 and where we are right now, it shows that kind of, and again, I'm not trying to predict gloom and doom here. I'm a long-only investor. But if you look at that chart, it shows almost a straight line type of drop in that 2008 timeframe. If you look at the 1998 cycle we just completed, we're in kind of a straight line drop phase. If you go and you look at that 1937 comparison, same straight line drop phase. So if rates continue to rise, right, and you have Jay Powell talking tomorrow, which could very well serve as a catalyst to keep pushing rates higher, and the dollar continues to strengthen and Powell does what he wants to do, which is tighten financial conditions, equity prices haven't fallen enough in the last 2 weeks to account for what we've seen taking place in rates. And that's why I was also kind of getting to that historic point the other day.
Thank you. I appreciate that. I know you're not trying to do doom and gloom. As I said before, we learn from studying history and looking at the patterns, and that's exactly what you've been doing. So I appreciate your professional opinion on this. So it appears that, we all know it takes time. There's data lag. There's time to work through this whole process. It took us time to get into this, and now it's going to take us time to get out of it for recovery. We will have recovery. Do you think that recovery may begin in 2023, or do you tend to be more in the 2024 camp?
No, I think that once we get to the point where the Fed kind of stops and the market has repriced, meaning rates are kind of stabilized again, and earnings growth can return, I think you can start seeing the market recover. It is not going to be what we've been accustomed to, though, of the last 10 years. I think this will be more of like a 2000-ish, 2001 type of recovery where it can take a year, 2 years, 3 years before, maybe 4 years before we see new all-time highs again. I mean, look at what happened in 2009. We didn't see new all-time highs again for quite a number of years. I don't think this is going to be like in fact, I'm just looking at the chart right now. We didn't see a new all-time high in the S&P 500 really until almost the middle of 2013 following that decline. And so I think that's what this is more like. There's going to be there's no physical stimulus coming really like we've seen. The Fed's not going to be so quick to just reinstitute QE after it's gone through all these steps to kind of end it. It's made it very clear that it's going to hold rates high until it's clear that inflation has peaked. So I think what I'm trying to focus on right now is finding companies that can deliver above average revenue growth, have very high margins, and can deliver obviously above average earnings growth. And I think if you can find those at the right valuations that are real businesses, right? Not just kind of on hope and a prayer, then I think that's where you can probably do very well. And that's what I'm sort of focused on right now.
Thank you. Are there any particular ones that you're focused on or any sectors that you are looking at closely?
So I bought Intuitive Surgical in June. I bought them because they're obviously the leader in kind of robotic operations. What kind of got me on this was that I had a back surgery last year on my L5-S1 disc. And going through that process, I realized that there were a lot of things that really are, from getting imaging done. We're still using a lot of technology that I thought was fairly old, but we're also using a lot of technology that's kind of new. And so I kind of went through this process of looking for companies that are going to have, cutting edge technology specifically in helping people, especially in an aging population, can help in aid in operations and surgical procedures, or provide the kind of joint replacement parts. And so I went through that sort of phase, and I recently bought Shopify in May, again, because I use their product regularly and make it very easy to integrate, very joint replacement. And so I went through sort of looking at, business, again, kind of a good revenue grower, earnings, good margins, solid earnings growth. Once it gets kind of past this little phase that it's been in through this consolidation, I think it will be there because, again, they're doing things with the way the inventory system works there, with the way that they're allowing you to build your store out in your website, the drop shipping stuff capabilities they have. There's a lot of things going on there that I really find, as a business person and an entrepreneur and someone who's trying to be innovative and trying to figure out how to build new revenue streams for my business, I find very useful and very easy to do. So those are two things that I recently purchased. And then I have other names on my list that I'm sort of keeping an eye on that fall into that sort of thematic categories, whether it be medical or even a lot of times it's what my kids are doing a lot of.
Of course, through experience, we know what to buy. If we use the product or we use the service, it tends to be a little easier when you go to buy the stock. Thank you so much, Michael. If anyone has questions for Michael, please submit them in the thread, and we can go through some questions right in about a minute. I just want to say thank you, Michael. We appreciate your discussions very much. Although you revealed some undesirable chart comparisons, I think we all rather just know than be in the dark. And there are excellent tools for study, hopefully assisting us in making more prudent decisions that lead to an improved and better tomorrow. So I have some questions here. I have a question for Chris. Chris, I think
Yes.
you, how do you determine the stages?
So simply, I mean, if you're in a stage two, you're above the 200-day moving average and you're just trending higher. If you're in stage four, you're below the 200-day moving average and you're trending lower. Stage one and three are similarly the same. They're just sideways bases. It's basically where you're looking some churn in action. Stock really is not going higher. It's not going lower. It's trying to make a decision. Does it want to continue a trend up? Does it want to go down? They're almost one and the same. Basically, a one stage comes after a long downturn, so a stage four, and a three usually comes after a two. Obviously, with the numbers, it's pretty straightforward. But they look exactly the same. They're just sideways bases. So a two is up and above the 200-day average. Four is down and below the 200-day average. That's really the two key things you want to focus on.
Perfect. Thank you. Now we have a question for both Michael and Chris. When you look at some of the best of breed, and they use the term fallen angels, I believe, now trading at low to mid single digit ARR multiples, such as Twilio, Okta, OKTA, DocuSign, Coop, and Veev, VEEV. I guess they want to know what you look at with some of those in that level.
I guess I'll take this first. So and I've owned a couple of those in the past as well. I mean, the key thing to look here is some of these stocks in during the pandemic and during the COVID lockdowns just got ahead of themselves with sales, got ahead of themselves with valuations. I mean, some of these stocks are trading 50x, 60x, 80x over sales, and then just historically that's too high. They couldn't keep up with that. And as we've seen, I think each of those names have all come down anywhere from 40 to 80%. I do think some of those stocks will come back in the future. It could take a lot of time. The one thing that Michael kind of touched upon more from a macro perspective, and I think this is going to apply to a lot of growth stocks, especially some former leaders, is an inflationary environment and a recessionary environment. If we get into one, they're long duration events or just longer duration events. I mean, they don't turn on a dime. They're not V-shaped type events. It's not a black swan COVID type event that happened in February and March of 2020, where it just bounces right back and we're right back to new highs. It takes a long time. One of the key things I really believe in, I tweeted it out recently, is just don't fight the Fed. We don't want to fight the Fed. However, when the Fed starts to soften up a little bit, the market is forward looking. And the key thing I look for in any stock, whether it's those names that were mentioned or other stocks that become new leaders, and the market in the future, when we go into a new uptrend in market, we will have a lot of new leaders, names that we're not familiar with today. You want to look at stocks that are growing their earnings Q over Q. And if they're growing those earnings, and of course with sales as well, you want to make sure it's sales and earnings kind of tied together. And if they're growing both of those Q over Q and year over year, I mean, those are the stocks that are really going to lead the market if they're in the leading industries. It's not hard to find the leading industries because you're going to have many stocks from that industry that are all kind of making that same move together. And you want to really focus on the two or three top stocks within that industry and buy them. Too many times I see people say, and I'll go back to the original example during my career was Intel or AMD, which one do you want to own? Which one's better? And so many people try to pick which one's going to be better. Just buy them both. Why not just buy both the leaders in the market? Maybe you just allocate a little bit more heavily to the one that you prefer, or the one that you favor a little bit more, but buy them both because if the industry's strong and the market's strong, they're both going to go up at that point. So why play a guessing game? Get a piece of both of them, ride them both up.
Love it. Thank you so much, Chris. Michael, do you have a response for that question as well? Your perspective.
Yeah, so I wrote on several of those over the year and a half, meaning I did research on them, published material on them, and I can't speak for all of them, but stocks like DocuSign, Twilio, those type of names, even the Zooms of the world, the Rokus of the world, were just completely overvalued. Never should have had the valuations they had. And it was, if you go back and read the work I did, you'll see that basically the market was assigning multiples to them that were just impossible for those stocks to ever grow into. And, and that's momentum. And the thing that I learned in the 2000 experience was that a lot of the stocks that sort of led the charge higher, as they came down, they looked like they were getting cheaper, but they weren't getting cheaper. They were getting cheaper in terms of price, but they weren't getting cheaper in terms of valuation. And a lot of them never recovered. And so I think you have to kind of go through. And I mean, look at Qualcomm, for example, or Cisco. Qualcomm took nearly 20 years to return to its all-time highs, and Cisco has still yet to do it. I think Intel is in that camp too. So what I'm trying to say is that I think when you go into a name like some of the fallen angels, you can't go in with the expectation that they're going to return to their previous highs. You have to kind of go into them with a newfound expectation, not what it was, but look at what the estimates and the growth potential is for it now. And then you have to assign the valuations for what the market is giving it now. And that's how you have to think about it. And so just as long as you have an open mind that these things may never return to those levels again, I think that's the way you have to approach it.
Thank you, Michael. Now, does anyone else have any other questions? I see someone's requesting here. If you could please write your question in the thread, that would be great. Otherwise, we are way over time. I promised Michael that we don't go no past 8:15, and we're past it. Chris, do you have any other words or any other thoughts you'd like to share with everyone?
Yeah, kind of just to recap what we talked about tonight. If you're more of a longer term investor, and if you're going to combine the fundamental aspects and the technical aspects of part of your investing toolbox, you want to learn just the basics. I don't go into a lot of different indicators on the charts themselves, but the key thing is just, and I use 200-day moving average because it's something that a lot of the folks that I've kind of read before that have had success in the markets over the last so many decades have used, is just you can buy when you're above a 200-day and probably want to sell when you're below the 200-day. I mean, that's really the main thing when somebody sums up, what do you do for investing? It's, I'm looking to buy when we're above the 200-day. And there's two things. You want the stock and the index. And of course, stocks in the industry to kind of be above that 200-day. And if you have that, you're probably in a pretty good market. You're probably going to have pretty good chance, pretty good odds of actually making some money in the market itself when it goes below. And there's lessons I've learned. Like I said, I've been doing this since 1998, and I made plenty of mistakes between 2020 and today of what I did with my portfolios, where I could have did a lot better in hindsight. And that's just going to happen. That's human nature. We're never going to be perfect at doing this. And a lot of this is just kind of trading or guessing the odds itself. I mean, looking at a chart is not going to tell you where the stock's going. It's just going to tell you historically, as you said earlier, things rhyme. They don't repeat, but they rhyme a little bit. So it kind of sways the odds a little bit in your favor, a little bit to your advantage. So for now, I'm sitting here in early September. I've been patient since February. I mean, if I have to sit patient for another 6 months, I will. But until the market actually aligns where the odds are in my favor for what I do within my investing style, I'm going to sit and wait for that. I'm not going to try to guess the bottom here because I don't know where the market's going to go. It could drop. I mean, any one of these stocks that we're talking about today that are already down 80% could drop another 50%. And people kind of say, really? Could they really do that? Yes, they could definitely do that. I've seen it happen. I watched what happened from the peak in 2000 to the low at the end of 2002. And it was a long, long 2.5 years. And you just couldn't believe how low stocks were really going to go. Certainly these stocks can go lower. And the generals, I call them the generals in the market, your Microsofts and your Apple and your Tesla and Google and stocks like that. Many of them are below the 200-day moving average now, and they're starting to set up with what may be a stage 4 type breakdown or decline here. If those stocks start to break, the indexes are going to break a little bit further. So we could be in for some more pain, minus the bear rallies, but some more pain just longer term here. So we'll see what happens. I'll let the market tell me what's going to happen. I'll kind of just trade based off of that.
Thank you so much, Chris. Michael, do you have any other things you'd like to wrap up with, please?
I agree with a lot of what Chris said. I think the other thing is just kind of remain open to different possibilities, and just because something seems like it's super unlikely to happen because this time it's different, keep in the back of your mind that maybe it isn't, and just consider it. And that's what I've always done as an investor, because I think that you'd be surprised how things work out sometimes. And that's one of the reasons why I like to look historically at what's happened in the past.
Thank you so much, Michael. I want to thank everyone who came to our space tonight. Thank you so much to Chris and Michael for sharing all their knowledge and experiences and taking their time in this beautiful evening, the last days of summer, I call them. I appreciate you both very much, and thank you to all the listeners. And the more I learn, the more I realize how much I don't know. And that's a famous quote from Albert Einstein, but I really feel that way. There's so much learning to be done, and that's why we're here. And I just want to say thank you for everyone for coming tonight. And good night to everyone.
Thank you, everybody.
Thank you.
Thank you.
Bye-bye.
Thank you.
Bye.
Thank you for listening to the Rose Show podcast. Please visit rosannaprestia.com for more episodes. See you soon.